Welcome to the M2I Alternative Investments Chat, where we demystify the world of alternative investments and financing for entrepreneurs and investors alike. With these discussions, we hope you're more empowered to unlock new opportunities in your business or portfolio.
Hello and welcome back. This is part 2 of our episode dedicated specifically to advisors. Now we're going to talk about some of the operational and technological aspects and regulatory issues that advisors face. Erica, I'm wondering if you can touch on some of those operational challenges that advisors face when managing alternative investments for their clients.
Yeah, absolutely. So there's the manual processes themselves. So many of these alternative investments, they require a lot of data entry in spreadsheets and running very lame calculations. It can be very time consuming. Advisors, we're human, we're going to make mistakes. And so that is something that we really want to try to avoid. But that sometimes comes with a manual process. Then, like I said, there's that data management, alternative investments. There's lots and lots and lots and lots and lots and lots, and maybe one more lots of data included in that. And so you have to think about the managers, the custodians, third-party administrators. There's a lot of stuff that goes into collecting all of that data. And then again, we kind of briefly talked about it in our last episode, the compliance and regulatory requirements. Every single one of these investments is under a different regulatory field. All of them have different how much you can collect, the time frames, forms. So sometimes advisors will steer away from these types of investments because there's a lot of extra work to do in them. That's not always the case. There are now programs out there that are automated. They use your data and migrate it into the system. So again, those calculations are done by a computer, which is a lot smarter than me, and hopefully a lot more accurate than I am as well.
Yeah, I love that. AI is taking over the world or something like that, but it's definitely helping us out in terms of being able to tackle these large swaths of data that can be so time consuming, as you said. So can you tell me a little bit about how advisors should determine the suitability of alternative investments for their individual clients?
Yeah, so you want to, again, talk to your investor, talk to your client. You need to understand what their objectives are, whether they're seeking capital appreciation to generate income, risk mitigation, or if they're just looking to diversify their portfolio. There's that whole saying, don't put all your eggs in one basket. You don't want to put all of your investments into one thing. You want it to be an array of different items. So first you want to talk to them and figure out, what do they want to do? How much of that typical 60-40 profile do they want to actually put towards alternative investments? You want to talk about the risks. There are risks in everything in alternative investments in general, whether traditional or alternative. You need to make sure they fully understand that there is no guarantee that they're going to make money. Risk is a big thing. In fact, they made a game out of it, right?
Yeah, and you have to see how much of that risk your client can specifically tolerate. You might have a client who's, ready, gung-ho. They're like, let's do it. They've got maybe a little bit more money to play with. They want to invest in something that potentially could have really, really high return, but also could have really high risk. Then you might have a client who's not game for that. They want to invest in something that's a little bit more stable.
Exactly. Always, you have to talk to the client. You want to talk about, when we're talking about that risk, also comes that time horizon. How long can this person go without these funds? We talked in last episode that sometimes keeping the money in longer potentially can bring more returns, but can you go without $50,000 for 5 years? Some people, yes. Some people, no. Just depends. So you, again, talk to the client, make sure that they understand certain investments require a certain amount of time. Not all, but some. And then there's also the fee structure. So just like with anything, even ordering a pizza now online comes with some kind of fee, delivery costs. By the time you end up out the door, it's 10 times higher than what you're thinking. Now, that might not be the case for investments, but there are definitely fees. You have to pay your advisor somehow. And a lot of these investments also have fees associated with them too. So you want to make sure as an advisor that you're putting all those in so that the investor can actually see what the final amount is going to be.
Right, because if your fees outweigh your potential returns, then
What's the
that
point?
doesn't really make much sense.
Exactly. And then the client education and communication, you always want to talk about all of these things above that we just talked about with your client. They need to fully understand. Again, there's no guarantee you're going to make money.
It's that transparency. It's huge.
Exactly. And that's what's going to win that trust over with your client.
Yeah, absolutely. Something else that I wanted to touch on are some of the potential regulatory hurdles advisors encounter when they're incorporating those alternative investments into a portfolio for their client. I'll kind of kick this off. You've kind of touched on it earlier, but those suitability requirements, there's regulatory agencies that I'm sure lots of us have heard of, the SEC and FINRA. They require advisors to recommend investments that are suitable for their clients based on those factors that you just mentioned above. So you have to, fall within those regulatory compliance, and also, you have that fiduciary duty. This is how you do that. But that can be a hurdle when you're trying to incorporate that into your client's portfolio. You're trying to match the appropriate investment to the client. Sometimes that can be difficult.
Extremely difficult.
And then there's disclosure requirements. Advisors have to disclose all the things that you talked about: risks, fees, conflicts of interest associated. So if there's an advisor, their best friend, their buddy has an investment, maybe it's a really great investment, but also that's that advisor's best friend. You have to disclose those things.
Absolutely.
And sometimes that could be a hurdle or a challenge for the advisor.
Exactly. And then you always want to just remember that some of these investments have different requirements, that accreditation. So we briefly talked on it last podcast, but to be an accredited advisor, you have to make investor. You have to have $1 million worth of assets, excluding your primary residence, or you have to make $200,000 the last 2 years. You're planning on making $200,000 the year that you're investing, or if you're with a spouse, that number is $300,000. So some of these, the client, you're as an advisor, you want to make sure your client understands that some of these investments are off limits because you might not be accredited.
Yeah, definitely. And you have to verify that accreditation for your client. Again, not only to see what investments they're able to invest in, but also to cover your butt. Because if
Exactly.
you have an investor and you get them involved in an investment where they need to be accredited, but they're not, and you didn't verify that, you can get into some hot water. So
Yes, you
that's something that you have to do as well. Erica, what are some of the best practices for monitoring and reporting the performance of alternative investments to clients? How do you do that?
Well, it's that due diligence. It's that frequent performance reviews. You want to conduct regular performance reviews and updates on the client, updates with the clients, should I say, to assess their performance in those investments. Always making sure that the investor has the information. Knowledge is power. We said that earlier. Knowledge is power. We want to make sure that they fully understand how this company has been doing. Goes back to transparency and disclosures. Again, you have to tell your guests, or you have to tell your clients comprehensive disclosure regarding the performance of that alt. You want to make sure they fully understand. Always being open, honest with your investor. And then there's customized reporting. So there are platforms that can run statistics and run reports and due diligence for you. But again, it needs to be tailored to each client. Everyone's money is different.
Yeah, exactly. And there might be an investor that wants to see how their portfolio is growing month over month. There might be an investor who wants to see it every 6 months. It depends on the investor and what they want to see, how their investment is growing, what metrics they're interested in. So if you could really tailor that reporting to what your client wants, that could be highly desirable.
Exactly. And that leads us to our next question, which is, how do you manage a client or investor when it comes to, they really want high return and they have this idea that this is how it should go? How do you explain to them the inherent risks?
Yeah, so there's always a trade-off, right? If something is more risky, you might have higher returns. We mentioned that earlier. If something is less risky, you might have less high returns. So it just depends on the investment, varies from investment to investment. So if you can help your client to understand the fundamental principle of risk return trade-off, how that works, and specifically educate as best you can about that specific investment that they're investing in, what the risk is, what the potential payoff is, and the return, that will really help you. And again, higher returns typically entail taking on that greater risk. We've said this before. So, the 12, 13% might look really attractive, but it might be riskier. You have to assess, is your client willing to take that risk on?
Yeah.
Also, you have to set those realistic expectations. And this is really true of anything in life. You have to set your expectations to be realistic. And you have to think about the long-term perspective. You think about the stock market. I think that one of the things that people think about is that, the graph of the stocks going up and down, up and down. So we know that over time, you might see an overall increase, but you might see some drops here and there. Although an alternative investment doesn't work just like that, I think that's a great way to think about it since people are more familiar with stocks overall.
Yeah.
The longevity of your investment, you might be able to see those higher returns as it goes on, but there might be, some dips. So you have to think about that long-term perspective.
Yeah, realistic expectation means you might not get any money. Yeah. Got to be okay with that.
Yes, exactly. And always, I think you have to discuss the potential downsides with your client. With investments, there are a lot of potential downsides. There's also a great upside, which is more money, but there is a lot of potential downsides. I don't want to say it's like gambling because it's not. The stakes and you have a lot more information, but, there's a potential that it might not work out the way that you planned. You go to play the slots and, you hope that you walk away with $500, but maybe you don't.
Big money, no whammies, no whammies.
Yeah, exactly. So, and that's different, but it's kind of a way of thinking about it that there might be some downsides to this. Also, some downsides, you're not going to have access to your money potentially for an extended period of time. That might be a potential downside to you. Now, again, that reward might be worth it, but that is a potential downside to consider. And those are all things that your advisor can discuss with you. And, if you're the advisor, that's your job to tell your client about all those potential downsides.
Just seems like as an advisor, the big overall theme is be transparent.
Yes.
Be transparent, be transparent, be transparent. Tell your clients, your investors, all the information you can possibly tell them to fully make sure that they understand what is happening.
Yeah, and they'll appreciate that. If you're able to give them as much information as they can, they'll develop that trust with you. They'll feel safe. When people are giving you their money to invest, a lot of people feel very emotionally tied to that. That's something they've worked really hard for, and they're trusting you to take care of it and help it grow. And, you have to build that trust. And again, transparency, that's the way that you can do that.
I love it. So I think that's going to wrap up our discussion today for operational, technical, and regulatory challenges that advisors face in the alternative market.
Thanks for joining us. Stay tuned for more insight on our next episode, and don't forget to subscribe to continue the journey with M2I. See you next time.
The content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.